Hi, in this lesson, we'll look at three components of net cash flow. These components derive from changes in a company's income statement and balance sheet items. Cash flow changes deriving from the income statement are a result of the company's operations and can therefore be considered operating. The term operating indicates that these cash flows are part of the company's core business. The other two types of cash flow movements we can have are investing and financing, which are mainly seen as a result of changes in the company's balance sheet items. So, to summarize, we have three types of cash flows. Cash flow from operating activities, consisting of cash transactions affecting a firm's net income. Cash flow from investment activities, resulting from investments in fixed assets and other long-term investments. And cash flow from financing activities, made of transactions that affect a company's capital structure, both debt and equity. It's important to be able to distinguish among these elements, as it will give you a better idea of where the company makes and spends its money. For example, a company's operating activities could generate a significant amount of cash. However, the company may have very high leverage and a significant amount of debt that matures within a few months. This can be a potentially dangerous situation. The breakdown we see here allows a quick diagnosis of where cash is made and where it is spent. It brings clarity and direction. And, of course, the sum of the three types of cash flow gives us the company's net cash flow, which reconciles with the change in cash we see on the balance sheet. A company's net cash flow is equal to the difference between the amount of cash that was registered in the current period and the amount of cash that was observed in the previous period. This is an important rule we'll use in one of our next lessons.